One company just flipped a $13 billion crypto loss into $1.4 billion profit in days. Bitcoin has rocketed past $79,000 this week, and the rally is being fueled by a powerful mix of forces. Wall Street institutions are pouring capital into digital assets, while macroeconomic conditions, including softer inflation data and expectations of rate cuts, are boosting risk appetite. At the same time, Washington's tone toward crypto has grown noticeably friendlier, adding fuel to the fire. Institutional buying has been a major driver, with large asset managers and corporate treasuries adding Bitcoin to their balance sheets. Analysts say this steady demand is providing a floor under prices even during volatile swings. Meanwhile, improving relations between crypto firms and federal regulators are giving big money managers more confidence to enter the market without fear of sudden crackdowns. The rally accelerated sharply after billions of dollars in short positions were liquidated within just 24 hours. Traders betting against Bitcoin were forced to buy back into the market to cover losses, creating what's known as a short squeeze. This cascading effect pushed prices higher even faster, illustrating how leveraged bets can amplify momentum in either direction across crypto markets. Next up, while Bitcoin surges, a warning is coming from inside the tokenization world. Tokenized stocks, digital tokens meant to represent real shares, are gaining popularity as a bridge between traditional finance and blockchain. But Fairmont's CEO is sounding an alarm, comparing the trend to Wall Street's infamous 1960s paper crisis, when a flood of physical stock certificates overwhelmed back-office systems and nearly crashed the market. The concern centers on settlement and reconciliation, the unglamorous plumbing that keeps markets functioning smoothly. If tokenized stock platforms scale rapidly without robust infrastructure, mismatched records and slow settlement could create confusion or even gridlock, echoing the chaos that once forced the New York Stock Exchange to close early for months just to catch up on paperwork. The warning arrives as more companies race to launch tokenized equities, promising faster and cheaper trading than traditional markets. Critics argue that without stronger regulatory oversight and standardized systems, the industry risks repeating history, just with digital tokens instead of paper certificates. It's a reminder that innovation in finance often outpaces the infrastructure needed to support it safely. Meanwhile, back in the crypto markets, the Bitcoin rally is lifting far more than just the coin itself. Bitcoin's climb above $79,000 has triggered a broad rally across crypto-related stocks. Mining companies and corporate Bitcoin treasury firms are seeing some of their sharpest gains in months, as investors bet rising Bitcoin prices will directly boost balance sheets and profitability. Specific winners include Canaan, Strive, and Metaplanet, all of which posted double-digit percentage gains as the rally gathered steam. Canaan, a major Bitcoin mining hardware maker, benefits from expectations of increased mining activity. Strive and Metaplanet, both corporate treasury players holding large Bitcoin reserves, saw their share prices surge in tandem with the cryptocurrency's own gains this week. Analysts note that the correlation between crypto stocks and Bitcoin's price has reached historic highs, meaning these equities now often move almost in lockstep with the coin itself. This tight relationship means investors treating crypto stocks as a proxy for Bitcoin exposure should understand they carry the same volatility, sometimes amplified, as the digital asset they're tied to. And the volatility story doesn't end there. This week also saw one of the most dramatic short squeezes in recent memory. According to CoinDesk's weekly roundup, Bitcoin and Ether bears got absolutely decimated as a squeeze-led rally caught traders off guard. Billions in short positions were wiped out in a matter of hours, forcing a wave of forced buying that pushed prices sharply higher. In another major development, Elon Musk's X platform announced plans to pay content creators using stablecoins instead of traditional currency. The move signals growing mainstream adoption of stablecoins for everyday payments, not just crypto trading. If implemented, it could give millions of creators direct exposure to digital dollar-pegged tokens as part of their regular income. Together, these stories highlight a crypto market in rapid transition, one where speculative trading and real-world payment adoption are colliding. The scale of this week's liquidations, combined with major platforms embracing stablecoin payments, suggests the industry is entering a new, more volatile but also more integrated phase with mainstream finance and social media. Now let's head to Washington, where regulators and lawmakers are making major moves of their own. President Trump reportedly urged crypto executives this week to help pass what he called a fair version of the Clarity Act, legislation aimed at establishing clear rules for digital asset markets in the United States. The push reflects growing political pressure to finally resolve years of regulatory ambiguity. Adding urgency to the situation, the Commodity Futures Trading Commission warned that if Congress fails to pass the Clarity Act, it will move forward and write its own rules for crypto markets. This warning signals the CFTC's willingness to act unilaterally, potentially reshaping how digital assets are regulated even without new legislation from lawmakers. Meanwhile, the SEC abruptly advanced its first-ever framework for crypto fundraising, marking a significant shift in how the agency approaches token sales and capital raising in the digital asset space. Combined, these three developments, Trump's push, the CFTC's warning, and the SEC's new framework, show Washington moving faster than ever toward comprehensive crypto regulation. Back in the corporate world, one company's Bitcoin bet just paid off in dramatic fashion. Strategy, the Bitcoin treasury giant formerly known as MicroStrategy, has swung from a staggering $13 billion unrealized loss to a $1.4 billion profit as Bitcoin's price rallied. The dramatic reversal highlights just how volatile and potentially rewarding corporate Bitcoin treasury strategies can be. The turnaround happened once Bitcoin's price climbed above the company's average acquisition cost, flipping its massive holdings from a paper loss into a paper gain almost overnight. Strategy has built its entire corporate identity around aggressive Bitcoin accumulation, making its financial results one of the most closely watched proxies for institutional sentiment toward the cryptocurrency. This swing underscores the high-stakes nature of corporate crypto treasury strategies, where balance sheets can shift by billions of dollars within weeks. It also raises questions about how other companies considering similar Bitcoin holding strategies might weigh the potential rewards against the extreme volatility that comes with tying corporate value so closely to a single, unpredictable asset. Switching gears now to a major story outside the crypto world, TikTok just wrote a very large check. TikTok has agreed to pay $400 million to settle a children's privacy lawsuit brought by the Department of Justice. The DOJ is calling the settlement a major victory for child safety online, resolving allegations that the platform improperly collected data from underage users. But the settlement comes with an important caveat. The U.S. government never actually proved in court that TikTok violated the law. And for context, ByteDance, TikTok's parent company, is projected to earn roughly $50 billion this year, meaning this $400 million settlement represents less than 1% of the company's expected annual revenue. Critics argue the penalty, while headline-grabbing, may amount to little more than a cost of doing business for a company of ByteDance's size. Still, the case adds to a growing pile of regulatory pressure facing TikTok in the United States, even as the platform continues to navigate broader political scrutiny over its ownership and data practices. So here's our question for you. As institutions, regulators, and even short sellers all collide, do you think this Bitcoin rally has real staying power, or is it just another squeeze-driven spike? Drop your take in the comments below. And if you want twice-weekly deep dives into the stories shaping finance and technology, hit subscribe so you never miss what's next.